welcome back, everybody. Thank you for sticking with us. And welcome to what was described on the way in by someone as, bad luck, guys, you've got the graveyard slot. Which I can assure you, it's not going to be the graveyard slot. It's going to be lively and engaging because you are all going to help us with this. Over the next 35 to 40 minutes, we're going to talk about the shape of future flows. We're going to talk about where money is going now, where we think it's going to go tomorrow, and the day after tomorrow. I mean, not actually, proverbially. And through what? How's it going to get there? Is it going to be through mutual funds or something through something else? And I'm delighted to be joined by our fantastic panel. We have Sophie Kennedy, who is the co-CEO of EQ Investors. Is that correct? We have Martin Jenkins, who is the CEO of Jennings, sorry. Close. Jenkins, I thought you were a Welsh rugby player, sorry. Martin Jennings, who's the CEO of Parmenion. We have Christina Tian, who should be the CEO of Goldman Sachs Asset Management. And we've got Nick Hutton, who one day will be the CEO of BlackRock. So thank you for joining us today, ladies and gentlemen. And one last thing about our panel. Not one, but two people came up to me in the way to the conference today, one coming out of the tube station and actually one in here. And both of them said the same thing about two different people on the panel. They said, well, thanks for inviting me for your panel. I see you've got my former sales support on the panel today. So congratulations to Christina and to Nick for rising really high. And congratulations to Alex Barry and to Mark Elliott for spotting the talent of the future all those years ago. You did a great job. Right, so before we kick on, I'm going to put this here. You are our fifth panelist. Okay? You will be asking questions. You will be giving your views. And make it easy, as Heather says, put your hand up and we'll throw that to you. And if we don't, we'll just throw it randomly. And then we'll be at the mercy of that. So let's kick off about, so we want to understand where the flows are going now and where they're going in the future. Obviously, we're in extraordinary times. We've had 2 years of coronavirus or COVID. We've got the conflicts in Europe now. So I'd like to start off with each of you just talking about what changes you're seeing in the businesses at the moment in terms of where people are allocating money and whether that's because of the shorter-term trends or longer-term trends. And of course, we've got two asset managers, a platform and DFM, and a wealth manager, if I may call you that, Sophie. So let's start with Sophie.
Thank you for having me, everyone. I'm delighted to be here. Just to give you an intro into EQ Investors, as Richard says, we're a wealth manager. And we service predominantly IFAs and also private clients. Our focus is on sustainable investing. So I think throughout the panel today, you'll hear a lot from me about the sustainable world. In terms of the direction, we're actually asset kind of allocators in terms of using asset managers like Nick and Christina here. We have seen a monumental shift in responsible investing or sustainable investing. You will have heard terms ESG, impact. We're big in the impact space, and if I was to have to kind of highlight one area for us that's been key is really asset managers taking ownership of channeling capital towards the world's social and environmental challenges through kind of impact funds or ESG integration. So I would say that's kind of the biggest theme that we're seeing at the moment.
And is that every investment that you make on behalf of your clients? Or is it an either-or at the moment?
Good question. We have kind of minimum sustainability standards across our assets under management. We don't invest in the likes of tobacco, some parts of the fossil fuel market, gambling, etc. We also have strategies that are much more focused on impact investing, so kind of the dark green, and that's where we use positive inclusion. So we'll only invest in companies whose product or service, rather than the way in which they structure their organisation, is doing good. So the likes of kind of healthcare, climate change is a big one at the moment. So the climate transition, we're seeing more funds focusing on decarbonisation. And I think the way in which companies themselves are innovating gives asset managers a bigger universe to create these strategies that are much more focused.
Okay, so a big shift to sustainable. Who else here is a wealth manager or works a wealth management business? Show yourselves. Hands up. Only one, two. I was going to say bad luck, guys. I'm going to ask you this question. Is that something that rhymes through your businesses, or are you doing something differently? Do I have to throw the ball at you now? No? Go on.
Yeah, it's a bit different because I work for a Swiss parent company of NextWealth, and we've been ESG investing since 2000 as well. So, it's been a massive rise in Switzerland, maybe earlier, a bit like the Nordics, and there's a lot of catch-up being done in the UK now. And similarly, we've applied minimum standards, and they're dedicated more sustainable investment solutions alongside that. So it's clearly finding out with clients where their preference lies. We think it's a good idea across all our investment solutions, and that's why we have those minimum standards. But at the same time, people may want to go a step further. And one of those consequences is also how you report on it. So you engage clients more by being transparent. This is what your investment solution looks like on the ESG front, regardless if that's something that you're doing on a dedicated basis. So we do that for all our clients. And for the dedicated solutions, you do go a step further and you show more and more details because that's the clientele that's really interested in that.
Okay, so it's ubiquitous by the sounds of it. That's great. Right, Martin, what are you seeing at the moment?
Yes, so,
thank you.
So, Martin James, thank you for the invite. For those that don't know, we're a DFM business running a suite of MPS models. We run across active, passive, combination of active and passive, and ethical. Our ethical have been running for 10 years now. We've also got our own in-house platform. So some people call us a platform, some people call us a DFM, and I think, at the end of the day, we're kind of both. So to put some numbers on it, typically, we've been running our ethical portfolios for around 10 years. I think we're just coming up to the 10th year anniversary. And we would typically see about 10% of our monthly flows going into our ethical portfolios, 10, 12%. And over the last 2 years, that's increased to somewhere around 35. So potentially a sort of a threefold increase into those portfolios on a sort of weighted basis. So, I suppose that gives you an appetite piece, because on the platform, there's the ability to kind of switch from one product to the other. So I think we are seeing quite a big shift there, flowing between active and passive a bit, but mainly that shift across to the overall ethical portfolios. Interesting enough, we launched the portfolios and called them ethical. There's a level of screening that goes down through those, so we're not on the impact. We're firm believers in diversification, so we are running a multi-asset portfolio. We don't call them ESG. When I sort of look back and think now maybe we should have put a different label on them, and maybe that would have changed when we're back to marketing, but ultimately the demand's there. Whether we're maximizing that demand through labels is maybe something that we overall should consider. In terms of the recent, you asked a bit about the kind of recent troubles. I suppose from our side, that's really just comfort that we're giving back to advisors at the moment. We've got quite a small exposure through the underlying funds into Russia, and so I was surprised we haven't had as many calls maybe as I would have thought in recent times, but we're just fielding those. So in terms of overall, there is that big dynamic shift, and then more tactically recently, that there hasn't been a big set of questions about the troubles in Ukraine.
Okay, thanks. I'm going to come back to you in a minute and ask you where the other 65%, if there's any change in the other 65% of your portfolios. Christina, where are you seeing flows in the UK business? We'll come on to the global perspective a bit later on. And what trends are you seeing at the moment?
Yes, absolutely. And obviously, Goldman Sachs is a global firm, so we have great perspectives on the flows that are happening, not just in the UK, but more broadly as well. But in the UK, we've seen from our clients, not just in the last couple of years, but over a longer period, a shift away from UK equities, or at least UK equities used to maybe constitute about 50% of equity allocation, to go down to 30%, and in some instances much lower than that. And clients investing on a global basis instead. And I think that has wider sort of implications looking ahead, where portfolio construction, portfolio allocations, what they could look like. And clearly ESG outside of the UK has seen enormous flows. In the UK, we see flows, but we also, just as an indication of where things are going, we're getting a lot more questions. Obviously, new regulation about to come as well. So, yeah, you can get a sense of that being top of mind for our clients.
Okay, so increased interest in ESG, sustainable, responsible. Come on, guys, get your terminology sorted out. And less interest in the UK, in UK equities, presumably in favour of global equities. Is that right?
Yeah.
Okay, great. Nick.
Well, to start with, a couple of observations. Number one, it didn't take us very long to get onto sustainable. And number two, thank you very much for the shout out about my sales support efforts 20 years ago. And look, the big change, fundamentally, I think there is a massive transformation in the investment proposition taking place that is going to run through for the next 5-10 years. You know, gone are the days of the single line security or fund sell, which is why I think the UK equity portion of people's portfolios is really diminishing. And now is this massive focus on the whole portfolio. And what that means is a few different dynamics. One, we are seeing an increase in indexation, and that I really believe that will increase. Obviously, I mean, I would say that talking from BlackRock, but we do see it happening. We believe that, you know, fee compression and regulation and forces that surround our industry will continue to support indexing in portfolios, the first thing. The second thing is demonstrable alpha is massively rewarded in our market still and always will be. We are still a very active dominated market, and I think flows from last year showed that demonstrable alpha will be really rewarded by investors, particularly, you know, if you look down at Sophie's business. And within there, I think the more unconstrained and the more concentrated portfolios are going to be the ones that probably attract more assets going forward. So alpha is still very much a demonstrable alpha, handsomely rewarded, but more on the unconstrained and concentrated area. Third is, and this is yet to, I think, really start showing itself in portfolios, is actually alternatives. And alternatives for the last few years have been actually one of the biggest outflows. You know, absolute return products have really struggled. But alternatives, I think, in the next 3, 5, 10 years will become a bigger part of portfolios. And maybe we'll come on to talking about alternatives and how they fit in portfolios and all of the different actors within our ecosystem that we're all part of, how they will be facilitated into portfolios. And then, obviously, you know, sustainable, we've touched on it. It's everywhere, it's growing, and it's going to continue to grow. But, you know, we have to, as an industry, come over certain challenges to make sure that we make sustainable investing as clear and we bring clarity to the industry and the savings and investments market. And I'd say
just like we have on financial stuff, you mean?
Sorry?
Just like we have in the financial
exactly.
Side of things.
We'll keep on speaking in the Greek alphabet, and then hopefully, like that can hopefully confuse people more. And then the fifth is thematics, and you know, we look at thematics. We see thematics growing as a percentage of portfolios, but from a low base. But if we look at that versus the continent, you know, on the continent, thematics make up probably 40% of equity allocations in portfolios. Now, I know the distribution model is different on the continent, as in banks really dominate distribution. They have a lot more advisory market. And the problem in the UK has always been, where does thematics fit? You know, how do we fit them into portfolios? But I think as portfolio construction technology and understanding of drivers of return really accelerates, I actually think we'll start seeing more thematic exposures. Actually, Sophie touched on a couple earlier, healthcare, technology, biotech, robotics. I think we'll start seeing more of these products enter discretionary portfolios as understanding of true drivers of return becomes more prevalent with technology.
Okay, great. So quite a lot going on now. Does anybody want to add anything? Is there anything we haven't picked up? They got it all. You're good. You're very good. Okay, so nothing to add there. So we'll come back and explore some of those in a minute. Sorry, Heather. It's your gig. You can say what you like.
Hasn't been covered is distribution models and vertical integration. So we've talked about product structure, thematic, active, ESG, but we haven't talked about vertical integration. And I don't know if that's worth a mention in shape of flows.
So the question is then, how is vertical integration affecting flows? Is that right? Sorry, there's another one here somewhere. Yeah, AB. Here we go. Oh, fell short again, sorry.
The other area that hasn't been covered is the method of delivery of the product. We've touched on indexation, I guess talking ETFs there, but other ways of taking the product to clients as well will be interesting to touch on that. So we heard in the US before the death of the mutual fund. Where's the view here?
Okay, thanks. Got him. Right, so we'll go with Heather's question first. Anybody got a view on how vertical integration is affecting flows? Who's buying businesses? Martin, probably.
I'll go. Look, we're not. I think logically that a business like Parmenion could be seen as quite a kind of good core to build out a vertically integrated business from. We've got the product, we've got the platform, we've got the operations, but I think there's a very different kind of business model with those that run platforms. I'm with Andy Bell that was here, sat in this seat or that seat this morning, and he said that he won't buy advisors and won't buy distribution. I think behavior, it kind of makes sense on PowerPoint, but I don't think it makes sense in practice. I think there's ultimately a different culture between kind of advice businesses aggregating, and they're a very different mindset. We're technicians and builders. We're at the back end kind of making the products work. We're not at the front end finding clients. I think we need to have a symbiotic relationship between us. So vertical integration is a massive threat, because if we are not a chosen provider within those large consolidating firms, then potentially there's lockout. I've probably been around long enough now to see, for everyone that's consolidated or aggregated, somebody else is disaggregated and disconsolidated, if that's a word. So ultimately, you might get left with the rump, but the kind of more aspiring advisor firms typically will be driving on to do things themselves, and those are the sorts of customers that somebody like a Parmenion will work with. People who want to run their own businesses, people who want to maybe be directly authorized, people who have an interest in the underlying product and, making things better for their end customers. I think for us, there's more risk than benefit from going down the vertical integration. And to the question about product type...
Can we come back to the product one in a sec? Sorry, because I just want to explore maybe Nick and Christina with some of the partnerships you have or relationships you have. How are you seeing vertical integration affect or how's it affecting flows?
Yeah, I can start if you want. Well, we see it across Europe with a lot of the distributors in Europe, where everything becomes about partnerships and they become fewer but much larger. And it's a little bit different. It's not necessarily vertical integration the way we see it in the UK, but it becomes, for us, very important to work with these partners and be able to deliver everything to them, because they become so dominant in the distribution model. So
that's more about you doing more business with fewer people, rather than where the money's going?
Yeah.
Okay. Nick, do you know where the money's going?
So a couple of things on vertical integration. Number one, I think that the levels of M&A we're seeing in the market we're going to continue to see. There is a huge scramble for scale. There's a huge scramble for, well, it's almost a scale or die imperative in our ecosystem at the moment. So I think we'll continue to see more vertical integration. But as Christina mentioned, I think with that we'll continue to see certain levels of outsourcing, certain levels of partnerships. But even with vertical integration, I think, open architecture models, they will still be the model that a lot of investors crave. So yeah, partnerships, outsourcing, M&A to continue, and vertical integration we'll see a lot more of this year. Okay, we're going to come back to you in a minute, AB, in terms of the wrap or the structure or what have you. Sophie, there's been some chat about, obviously we talked about geographic, now there's some thematic, you talked about thematic. Do you think the way in which people asset allocate in this country, seems to, a lot of people do asset class and then geography, is that no longer correct? Is it the wrong dimension? Is it a dimension? How do we think about, as you say, healthcare and other things? How should we embrace that? And how might that affect flows? Will we get the take-up of thematic in the UK, do you think?
It's a really good question. It's very timely for us. We currently, from a risk management perspective, still allocate geographically. So we have kind of developed markets and emerging markets, and my portfolio managers can allocate accordingly within certain boundaries. The more that we focus on thematic investing, which we have been doing more and more so in the last few years, but really kind of for the last 8 to 10 years, these are global strategies, and so investing in a global strategy with a regional framework becomes very difficult because you're not in charge of where those companies are from a thematic basis. Industrials, for example, the kind of water and waste investments that we make are predominantly based in Europe. Obviously, a lot of the robotics and the tech side it is more US focused. So we are thinking about how we can better allocate, focus on our thematics. I would say that globalization, and I'm sure that we've been talking about this for years, globalization makes it less relevant where the company is listed. It's very much about where those revenues are being generated from. The UK market is a perfect example where they may be listed in the UK, but the majority of revenues are from overseas, and that comes with its own issues. Another issue that is really important if you're going to change the way in which you're thinking about investing is the factors that come with it. So there I'm talking about the likes of your market cap exposure, the type of style exposure that you have, volatility, etc. These themes come with their own factors, and so having the ability to be able to measure the factors that you have within your portfolio and then kind of monitor and be able to manage those accordingly. And it's something that we've seen hugely in the last 3 months, this idea of high growth, which is an area in sustainability where we're very focused on. Typically, those most innovative impact companies are those that sit on kind of the growth or the high growth end of the spectrum. They've really been hammered, and those valuations have come right down. And it's quite a dangerous place to be if you don't quite understand kind of the risks that you're taking within portfolios.
Okay, thank you. So AB, you were talking about structures, essentially roles of ETFs. Nick, you mentioned LTAFs and stuff. Now, does anybody here have ETF businesses? Nick, what do you think? So let's do the ETF bit first, right? And then we'll go on to LTAFs, right? But ETFs, very popular in other parts of the world, less popular in the UK. And I don't know whether that's to do with the plumbing or not. We can ask Martin that in a minute. But what's your view on tomorrow? What of BlackRock? What do you think the adoption of ETFs will be?
I can tell you what
like?
I hope
No,
I can tell you what I hope the reality.
Not what you've been told to say. What you actually.
No, I think.
Sorry.
Yeah, sorry. Let me get my notes out. ETFs, and it comes to Alex's question about delivery, and so. What we see great ETF growth in the UK, particularly with the more institutionalized end of the market and those that have the big centralized investment propositions. And typically the private banks in particular are probably our biggest supporters of our ETF business, along with a certain degree of wealth managers. Now, what has hindered the broader adoption or what has restricted the broader adoption of ETFs in the UK market is the fact that typically ETFs do not trade on advisor platforms, or they're not included in model portfolios. Fractional dealing or the technology supporting a lot of the advisor-led platforms isn't or hasn't supported the inclusion. And so if you add up access, education, and technology, particularly given the importance of the portal of the platform in the UK, then that is why we have a very big index mutual fund business here in the UK, where that is not so prevalent on the continent. It is to an extent in the US. So, to Alex's question, what changes the delivery and the mechanics of the delivery? Again, it is probably the technology that underpins the savings and investments market in the UK, and the advisor-led platforms are a really big piece of that. And that's not just it's not just an ETF story, but I don't want to keep on talking because we might come back to different products or structures later. But I think that's what's hindered it. But we are seeing we're seeing really, really strong growth with a certain end of our clients, and they are using the ETF to get a lot broader and deeper in exposures. So they are using, Sophie just mentioned factor exposure. Since the conflict started, we have seen a really big support of kind of quality factor ETFs, for example. And I think as those that build portfolios can understand the true drivers of return and hence can pick investment instruments to support their investment thesis from a broader kind of toolkit, we're seeing the ETF used more and more. And actually in periods of volatility, typically that's where we're seeing the ETF used as the tactical asset allocation vehicle of choice, particularly for asset allocators.
Okay, great. Christina, do you see the same thing? I'm going to come to you, Martin, about the challenge on the plumbing in a minute. But
we are slightly more beginners in the ETF world compared to our friends at BlackRock. But in the US, we have quite a significant ETF business, and there the direct indexation, absolutely, but also active ETFs is growing. Now, in the US, you have tax advantages buying ETFs, which drives a lot of growth there compared to in Europe. But we are seeing more interest of using ETFs. And then in terms of other structures, I think Nick touched on it briefly, but around alternatives, how can we deliver alternatives to retail clients, in particular the private markets? You have investment trusts. It has its pros and cons. You have in Europe, you have LTIF, you have the LTAF coming here maybe. But then there is semi-liquid, which maybe should be called semi-illiquid, because do they really provide that much liquidity? But I think there's lots to be done in that space, in structuring and the operational setup to enable clients to buy.
okay, and how long, because we heard Peter Harrison talking about it this morning, and the role that alternatives, and it's quite a broad category of assets, how long do you think it'll be before those are readily acceptable? Or maybe I should ask Martin this question, but I will. But what's your expectation? And then we'll come to the user side in a sec. What's your expectation?
In terms of?
So let's talk about LTAFs or facilitating investments through other structures which are not mutual funds and ETFs into more.
Well, we see
more interesting ways to
we've
take
already
asset
seen
classes.
a very significant wealth manager in the UK offering private market in a daily liquid structure, sort of blending public and private. So it has been done. I think you need to really understand the client base and the flows, and to not end up in a scenario that we had in 2008. So I think there are asset classes that should be illiquid and shouldn't really offer anything else. And you need to be really careful. But I think in the next couple of years, I think you will see an increase in the use of it. And also I think we as an asset manager, but also on the wealth side, have a lot to do in terms of educating clients on the benefits of including alternatives in different shapes into your portfolio.
So back to how we think about asset allocation again. Martin, there may have been some hints that it's quite hard for people to access some of these things. What would your view be on that?
It's such a big topic. Here we go. So there's a few things to this. Let's start at, ultimately, we would support any product that, in a sense, access to all kinds of structures, products, we would kind of support. But I suppose we see it from a couple of sides. The first one, then, we run pretty much, I would say, what's wrong with a mutual fund, if I'm honest. I'd start at that place. It works. We understand them. The costs are coming down. We know what we're buying. So we're careful we don't throw out the old just for the new. But when we look at it, we need to make sure we run a set of diversified portfolios. So are we getting true diversification would be the first one, or are we getting some element of correlated returns versus kind of what we expect, what's going on below the tin. The second one then is overall kind of liquidity, and how do we manage liquidity in this piece? Because at the end of the day, we're dealing with mass affluent customers who are kind of giving us their savings and ultimately want to have some kind of income strategy in retirement. So we need to make sure that at all stages we're solvent. Our investment team believes in bricks and mortar, but clearly LTAFs are coming. That causes us an issue, because what happens if someone wants money out of their pension? We try and take an equal kind of slug across the portfolio, and we have got a 6-month redemption period on the property fund. What do we do in that kind of scenario? How does that manage? Does the portfolio go in and out of kilter? So what seems really exciting and creates a wealth of opportunity needs to be put back into what I would call, the mass affluent consumer kind of world, who actually just want something consistent that they can understand. At each level, the industry loves to create complexity, loves to create, we like to think we know best, and we're very outward, sort of inward out looking, not outward in looking. So ultimately, how do we kind of reconcile those two things? So it might be right that LTAFs, for example, are the right structure moving forward, but that's going to make it very difficult for us to put inside the portfolios that we run, which then means that property will become an institutional investment or hold it separately outside of the portfolio. So I think what we might see, or we do see, is a sort of core and satellite type strategy. So we'll get the majority within the core. That's what we would advocate as a sort of provider of centralized investment propositions, but then there may be satellites around the side. So there are different ways of looking at the problem. There are operational challenges. I think most platforms have solved fractional trading kind of now, but you've also got to have consistency. If you've got investment trusts inside your portfolio, can you run them across all your tax wrappers? Offshore bonds, onshore bonds, pension. So you've got a number of different, so consistency for us is quite key. And then operationally, we're managing people's money in. We're the custodian. They give it to us to look after. And then when they want it, they want us to pay it out. They don't want us to put up a load of regulatory structures that kind of stop you getting your money out.
Okay, so that's very helpful, and you can still see the challenges between the ideas of the designers and the engineers, I think, come through there. So if you just one last thing, looking forward, what different vehicles or structures are you interested in, and do you think will help you deliver better outcomes to your clients?
So we, as Martin said, we're very focused on the end client and their abilities to get their money out as and when they wish. So we only invest in daily dealing, whether that's open-ended or off-platform. We invest in investment trusts, ETFs as well. So we sold out of property far before any of the funds gated. I think reputational damage in terms of being invested in a strategy where there's an illiquidity mismatch between how you can buy and sell that fund and what the underlying investments are is far too great versus the benefits of any diversification or return benefits that you might get out of it. So I think, Nick, you mentioned that for the last few years it's been very much about this equities, bonds, 60-40, and you don't need much more. I think with inflation coming through, with the kind of the swift actions of the central banks in terms of their rate hikes, it's clear that if you don't have alternative assets, you're going to struggle to create a real return over the next, hopefully not long, but it could be years to come. So we do invest in alternatives. There are open-ended structures that invest in closed-ended vehicles. It's getting slightly complicated, but it's all about the risk management and the due diligence that's done by my fund research analysts in terms of how the asset managers are managing the liquidity of the underlying funds.
Brilliant, thank you. Anybody got a question from the floor? Lady here.
This question's for Nick, actually. Just interested to hear, because obviously ETFs, we see the growth year on year, especially in Europe. What would you say the breakdown is between index funds and ETFs that are being used in the UK versus the continent? And because obviously we're seeing this number increasingly grow and grow and grow, but where is it really coming from? Would you say mainly the UK, Europe?
It's a great question. So in the UK, the index mutual fund market is probably the same size as the amount of UK investors' holdings in ETFs. Now, on the continent, ETFs far dominate index mutual funds are very limited to a very few markets. So, and where is that growth for the ETF coming from? It is coming from the core part of people's portfolios. So it's coming from those funds that have typically been 90 to 100 basis points in OCF, have had a low tracking error, have looked like a benchmark. And what it has done is allowed people who are constructing portfolios to use an ETF for some core exposure, like an S&P 500 at 5 or 6 basis points. And they can then use their cost budget to flex their investment thesis in other ways, whether that be alternatives, thematics, or some differentiated product to source return. But very much in Europe, Germany is a huge ETF market. They have big savings plans from the banks. Switzerland is a very large ETF market, mainly driven by, again, a lot of the private banks' centralized investment models. And Italy, again, very much a growing ETF market, but very, very much more tilted towards ETF versus index mutual fund on the continent. That money going into ETFs is going from either savings plans, or the other big dimension is the rapid expansion of the digital and self-directed investing market, which we're actually obviously seeing here in the UK as well. But in Europe, it is the digital investing market is going through exponential growth. And that is where the ETF is being used as the vehicle of choice to turn savers to investors. And that's massively fueling the growth.
And just to kind of elaborate a little bit more, so you're saying that basically there's like 50-50 index fund and ETF usage in the UK. Do you think that there's a problem then with the technology about obviously delivering the ETF functionality to wealth managers or advisors, or do you think it's the education piece?
I think it's all of the factors together. I don't think it's just a technology piece, although technology plays a part, but the education and the access is definitely combines. So it's not one or the other.
Thanks very much. We've got just over 3 minutes left, so I think there's 2 things we need to cover. One, very quickly, is do you see differences between flows in the advised or wealth market and the direct market? Very quickly, and if so, what are they? Christina, any view on that?
Yes, so much more on the thematics in the wealth market. And especially if we're moving towards more global, you have that piece. Also on the delivery in terms of active versus passive, we're very much an active house, but we do see some of these themes, the more narrow themes, being more suitable maybe to a passive. So we're seeing demand to be able to deliver that.
Interesting, perhaps a different perception of value. Anybody want to add anything to that? All right, we're going to go on to tomorrow as well. Who remembers tomorrow as well? Don't pretend you don't. I know. So we've talked about what's going on today, and lots of things going on. We've talked about what you think's happening tomorrow and what you're seeing tomorrow, and some other markets. What about the day after tomorrow? One thing that you're thinking about, which might change flows, change how you think. In the future, and don't worry, we won't come back in 5 years' time and hold you to it. Okay, so who'd like to go first on that? Sophie, do you want to go first on that?
Sure, I will. I think, for EQ as a business who are very values-driven, our whole kind of ethos and goal is to connect Mr. and Mrs. Miggins' capital with impact investing and their own values. I think the rise of kind of governance, COP26 this year, the UN Sustainable Development Goals, and the momentum that we've got to channel capital, everyone's capital, not just governments and corporates, but everyone on the streets towards solving these big crises that we're facing would be something that I'm very focused on.
So you see a world where the responsible outcome or the non-financial, the non-financial real world outcomes are alongside every investment that people make?
Yeah, absolutely.
Okay.
I mean, there isn't a trade-off in my mind between financial benefit and generating non-financial returns.
Fantastic. Christina?
Well, I'm going to tag on to that. I think we need to, the end investor and the clients we face off to want to see the impact, and so the reporting and actually having language that everyone understands in terms of what they're holding and the impact, the carbon intensity, and I'm sure you can use more plain English in that as well, but having much better reporting in terms of what ESG means and what it looks like in your portfolio.
Okay, Nick.
Wrapping up both of those into a great degree of customization. So you being able to customly build a line to your preferences.
Brilliant. Martin, you get the final word.
Probably more of a hope. So what do I want for the future? Some sensible conversation about labels and terminology. We've heard all morning this morning about kind of, how do we get more people investing? How do we get more people out of cash? If we haven't managed to convert people out of cash in the last few years when the interest rates have been pretty much zero, what chance have we got when the interest rates start to go up? And I think that there is a massive issue with engagement and language. I mean, I've shared with some people this morning that, just the language we use around the tax wrappers, who understands PCLS and UF+, who understands MiFID that comes in with ex post, next ante. We're so so up ourselves that we even use Latin terminology for frigging charges. I mean, it just costs. So I hope that we get, and now we've got SFDR and then SDR, and they can outdo each other on labels, and that's just going to be, imagine that 140-page document that someone was talking about this morning. It'd be 300 pages in a few years' time. Anyway, so let's just get some simplicity in that, and hope Consumer Duty does do what it's supposed to do and drive a cart and horses through that. So I suppose that's my hope. What is the one thing that we're working on, which I'm pleased out of this morning, is we're spending an awful lot of time on data and connecting people with their data, because at the end of the day, it's not our data. We're a custodian, and we've tried to solve the problem for advisors by giving them a single view of their customer, and I think we did that 15 years ago. The platforms helped create a report that you could never get out of the life companies. It took you 8 weeks to get a kind of valuation, and then you could get it online. So we've solved that problem, but the world's become different. The platforms now are the life companies of the past, and actually we need to aggregate and become custodians of data at a higher level than what sits in the platform. So that's what we're working on.
Brilliant. Thank you very much. Wow. I mean, that was a whistle-stop tour of quite a lot. And I don't know, because I'm not a scientist, how long ago Faraday stood here. Well, you were talking about him this morning. You must be, and about reimagining things. I think you'll find the insights we've just heard show just how much not only each of these businesses, but actually they represent the broader industry, have reimagined themselves and continue to do so, and how rapidly things are changing all around us, and that we're reacting to do it. The only people that really didn't come out of that bit well was the life companies, but they've been getting it all day. So apologies to the life companies. Ladies and gentlemen, please will you join me in thanking very much to Sophie, Martin, Christina, and Nick. Thanks so much.